It's not just our Reserve Bank, but of course the Fed in the United States very much in frame to the minute. Sally Ord, interest rate strategist from JP Morgan, and Stephen Nash from FIIG Securities. Warm welcome to you both. Let's just start with you, Sally. Let's just ponder that call, not so much today, but what their justification will be for holding out from now. What are you expecting from the statement?
Well, I think from the RBA this afternoon, I mean, we're going to see a fairly balanced statement. As you mentioned in the introduction, I mean, the market's sort of sitting here toying with the idea of, are they going to go before June, or are they going to wait till the second half of the year? So that's sort of I guess the context for looking at this afternoon's statement, to glean any sort of information which might suggest that the RBA are getting perhaps a little bit more optimistic than they were last month. But you know, the consensus expectation is for the cash rate to be left on hold this afternoon. And I suppose the one thing that's probably changed and surprised on the stronger side of expectations were those capex intentions data that we saw last week. You know, with mining firms expected to increase their investment sort of almost 50% in the 2011-12 fiscal year. That was, you know, our own economists here at JP Morgan had a pretty bullish expectation in, but even that was beyond their wildest dreams. So I think that's probably the thing that's changed, but at the same time, we're not really getting too much more clarity on the household sector, and whether this sort of caution that we've seen over the last 6 months is just a cyclical thing which is going to unwind in the second half of the year, or whether it's a structural thing which is going to stay with us for maybe longer than most expect. So because of that, I think, you know, the central case scenario is for nothing too different from the RBA this afternoon.
Stephen Nash, from your point of view, yes, capex was strong, but it will have been 6 months as of May since the Reserve Bank came out of hibernation. So why wait another month till June if they're having to be ahead of the curve? Are you with Sally on June or slightly earlier?
Look, I'd probably go for a RBA tightening around mid-year. I think there's a lot of unknowns out there right now. I think the RBA have highlighted that issue of consumer conservatism, and I think that will be the thing that people will be focusing on in the statement this afternoon, whether they highlight that again, and whether they elaborate on that a little bit more than they already have.
I mean, if you put the capex to one side, you got Bureau of Statistics numbers yesterday, Stephen. If you look inside the business part of those numbers, were you altogether confident?
Look, there are pluses and minuses in those releases. Again, we've got some more data out today. I think this GDP is shaping up to be an important number, because if it was negative, and I think the most likely outcome is a small positive, but if it was negative, I think that would ignite some sort of rally in the bond market. 10-year bonds have already broken through their 20-day highs. 3 years are getting close to that right now, so the market's shaping up. It seems to be tipping or betting on a weaker outcome for that GDP number.
Sally, we've seen globally the crude price really start to unsettle investors now. In some respects, question marks over the growth profile, the continued growth story in some of these particularly emerging markets as crude hovers around that 100 US a barrel mark. Are you saying that that's sustainable from where you sit, or it's going to perhaps see revisions to demand for a whole lot of other commodities?
Yeah, well, it's been interesting. I mean, at JP Morgan, we're very much of the view that this is not going to be a permanent increase in the oil price. And so the central case scenario that our oil strategists have penciled in is basically that Brent goes sort of back down to $95 a barrel at some point. But I guess, you know, there are a lot of things that are very difficult to forecast in the Middle East at the moment, so the situation is pretty fluid. But having said that, I mean, we're already at the point, given that it looks like, you know, sort of from Q4 last year to Q1 this year, price of oil has gone up just under 20%. So we've already shaved off a quarter of a percentage point on our first quarter global GDP growth forecast at JP Morgan, and we've also made upward revisions to global inflation for the first half of this year. So already the price action, or the run-up in the oil price that we've seen in the last couple of months, is starting to impact growth forecasts. We've shaved our US growth forecast for the first quarter as well. So what you tend to find with growth revisions is that they tend not to be one-off. So if you start upgrading growth forecasts, then there's usually more to follow, and similarly on the way down. And so I think, you know, the performance of the bond market just in the last couple of sessions, you know, where equities have done well but bonds have been unable to sell off, maybe is sort of telling you that the market's saying, look, the risk of perhaps further downgrades to growth and, you know, sort of ongoing tensions in that area might mean that around 3.5%. 10-year Treasuries sort of looking reasonably attractive. But having said that, near term there's a lot of event risk. We've got the ISM number tonight. We've got payrolls on Friday night. So I think the markets, and obviously Bernanke's speaking tonight too, doing his Humphrey Hawkins testimony. The market's probably a little bit wary about event risk near term.
All right. So I mean, if you got Stephen from where you sit, I guess the inevitable belief that the Fed is going to have to hike sooner than later, but you look at those short-term yields that have risen. What is that telling you?
I think the market has built in some possibility of a rate rise in the distant future, but look, I think right now talking about an immediate rate rise is a bit premature. I think we've got these negotiations going on in the Congress with regard to the budget. Now, that means I think that they're going to cut spending, so that'll be positive for supply. Also, that will have an effect on growth going out to the last quarter of 2011. So we've got oil depressing growth now. We're going to have a fiscal contraction in the US, also adding to that contraction. So, as Sally was saying, bonds are holding in there because they're expecting these lower growth outcomes.
Although, so far for the year, Sal, it's not been a pretty picture for Treasuries of all maturities. They've actually lost ground, well, at least in February, losing about 0.25%, and that indeed swung everything into a loss for 2011.
Yeah, that's right. I mean, I think the Treasury market sort of is an interesting one at the moment, and because of the very sort of unusual circumstances surrounding Fed policy, we've got Fed funds effectively at zero. We've got the Fed in the middle of, QE2, which still has another 3 or 4 months to run. So basically it's that sort of 5 to 30-year part of the curve which is has to absorb, the pressure for higher yields. The front end really can't do too much, especially while people like Bernanke and the New York Fed President Dudley overnight sort of sit there and still talk about this low rates for a long time. And so you're sort of getting the curve, the shape of the curve trading very directionally. When you get good data and everyone's optimistic, you get a sort of bearish steepening of the yield curve, and the reverse happens when people pare back those expectations a little bit. But certainly our sort of sense of the growth outlook in the US is that there's still more good news to come over the medium term, and for that reason our strategists at JP Morgan still remain biased towards higher yields in the US market through to mid-year.
All right, expectation that yield curve may flatten, but probably not throughout 2011, maybe having to wait until 2012. We've got Irish elections. We could talk forever and a day, the implications for the EU and settings there, but look, we're going to have to leave it and talk on that one next time. Pick it up when we know the outcome. Thank you both so much. Sally Orr, JP Morgan, Dr. Stephen Nash from FIIG Securities.